Some of these properties are put more like 10 to 20 down because they know they're going to get a low interest rate. The houses are very, very cheap. And with a few, dollars here or there to fix it up, or just a little bit of sweat of your own, you're going to have yourself a fantastic house right now.
Can we describe the markets for the low end, middle, and high end? What do those markets look like, Dominic?
Well, I can share with you an interesting statistic, Mark. For example, our company, which operates in company-owned offices, are in 7 states in the Northeast. Right now, our business in the $300,000 and under price range, believe it or not, I know this is going to be surprising, in the $300,000 and below price range, our business is up 50%.
I've seen that.
So there's no question that where the activity is today in the housing market is at the lower end of the market. And we're in Morris County tonight. In Morris County, for example, over $1 million, the market is dramatically different than the lower end of the market. So to answer your question, it varies by price point. I haven't seen, I've been in the residential real estate business in this market area for 18 years. I have not seen it been such a dramatic differentiation, but that's what we have right now.
So if you own a lower priced house, you have a much better market than the higher. Is that because the higher end homes have lost so much value, or people aren't qualifying for the higher end mortgages? Or can anybody explain why the high end's not selling?
I think part of the reason why the high end is not selling is more and more people are trying to keep as much cash in their pockets, so they're putting less of a deposit down. So you're financing more. And between the loan financing, obviously a $200,000 loan, the monthly payment is going to be significantly less than a $400,000 or $500,000 loan. And again, we don't have all these creative deals. Mostly everything has gone back to almost fixed rates, 30-year fixed, 15-year fixed. There's not a lot of these creative ARM loans. I mean, they're still out there.
ARMs are adjustable rate mortgages, right?
Correct. And a lot of people are not taking the risk on the adjustable rate right now because the premise and the talk is, with the rates being so low now, how long is it before they reach the 12 and 13, 14% that they were maybe 10 or 15 years ago? So people are skeptical to get into that type of loan. So they want to keep their payments at a certain level, and the higher the mortgage, the higher the payment.
You think there's a fear overall of economic doom in the country, people losing jobs, car manufacturers declaring bankruptcy, major corporations going under? Do you think that's a big part of what we're seeing as well?
I personally feel that's a big part of the mentality of buyers, the concern in the market. I mean, there's certainly a fear there today. I mean, I have an expression that the buyers today that are under contract are looking for a way out. They purchase a house, but they're not quite sure it's the right thing to do because there's so much negativity and so many things to be concerned about. And so they feel that it was a good time to buy. They may even feel they've got a good deal, but they're still concerned. So I think that mentality that you describe, I see it every single day.
Do you think people are afraid the market's going to keep going down?
It's interesting, Mark. When the prices were going up and it was a seller's market, the buyers had tons of confidence and were very excited about purchasing. Now that the prices are going down and it's a buyer's market, the buyers are concerned. It's almost the exact opposite, but that's human. I think that you see that all over and over again. It was very interesting. In addition to what Susan just said, your question about the higher end homes and why they're not doing as well. In addition to all the things that Susan said, which are right on, Warren Buffett was being interviewed on CNBC last month, and he said something that I see every day. I feel that I see every day. He said that the spending habits have been changed for a generation of Americans. And I see every day people who could even afford to buy a larger home, or just being a little bit smarter about the decisions they make financially.
Now, let's talk about the people that are in that, I'll call it the squeeze. Their homes are equal to or below the amount they owe on their mortgages, right? How much of that do you see? Susan?
I'm seeing quite a bit of that. Not so much in the sales right now of the homes because people, again, are still a little bit skeptical. Maybe Dominic sees that, but I'm getting a lot of calls that people want to see before they try to put their house up for sale. Can we do something to modify that mortgage? Or what can we do so that we don't have to bring money to closing? But that's probably 75 to 80% of the people now that are coming in looking to sell their house or do something with respect to their home.
Dominic?
Yeah, there was an article in the Wall Street Journal recently, and it said that 1 in 6 Americans are upside down in terms of the value of their house and the mortgage on the house. And a friend of mine said 1 in 6. Does that sound right? And I would tell you that sounds right to me. That's been my experience. That there are certainly a number of sellers out there that who need to sell, and the house is probably not going to bear in the market enough to pay off the mortgage.
Okay, so you've got a seller who's upside down,
Yep.
as you say. What are their options? Let's run through as many options as we can think of here tonight. All right, you mentioned mortgage modification.
Correct.
And actually, you did a show.
Yes, I
a
did.
show on Law Talk today. And just describe that briefly again.
Mortgage modification is basically where you go to the mortgage company, and it's probably best to go through with a financial analysis or with an attorney who sits down, analyzes your financial situation, figures out what you can afford for a payment, looks at the amount of money you owe, looks at the interest rate you owe, and works up sort of a solution. For example, if you're in a 6.5% mortgage right now, and your finances, maybe your income has depleted 20%, decreased due to lack of work or whatever the case may be, what you're looking to do is go to the bank and say, hey, listen, I've cut back on my hours, or I had to take a pay cut to keep my job. Let's take that 6.5% and let's take it down to 4.5%, what the current interest rate is. Or let's take whatever I'm in arrears in, and arrears being behind in your mortgage payments, maybe we can tack them on to the back. Or if you're in a 15-year fixed, maybe we can stretch it over to a 30-year fixed and almost cut your payments in half. So what you're looking to do is just alter the terms of your initial note.
How are the banks and lending institutions approaching that today?
It really depends on the individual person that comes in. I've had a couple that have come in with 15-year fixed, wanting to go to a 30-year fixed. And the banks are working very easy because they're not asking for a change of interest rate. They're just saying, hey, can I take and make this 30 years starting from today? And the banks are very receptive because they see that their income has gone down, but they would otherwise be able to make the payments if they stretched it out. Similarly, if you get some people that haven't really lost their job, that aren't looking to file for bankruptcy, and aren't significantly behind on their mortgages, 6 months or less, the banks are really trying to work with them. But if you get 6, 7 months more behind, then the banks start to get a little bit more skeptical, especially if you say, well, I can't come up with what they call a good faith down payment or a good faith deposit to induce the bank to stretch and modify that mortgage a bit.
Now, when you say banks, that would also include mortgage companies and other lenders, right?
Correct.
Not just banks, but